Hello and welcome. You are listening to the Investor Lab. My name's Goose.
My name's Gabby. That gets
And-
creepier every time.
I like to keep it entertaining.
Spicy.
Right?
Yes.
Spicy. I feel
Yes.
spicy. It's spicy.
How are you?
I'm full of tzatziki.
Oh.
I'm good. How are you?
Good.
What are we talking about today, Gabby? We talked about debt recycling.
Debt recycling. I really enjoyed this episode. I think it was good.
I'm glad. I'm glad.
I'm not a salesperson at all. Good. Very good.
You should listen to this because it's good.
You should do it. Have fun. Bye.
It's a very interesting episode where we talk about the idea of turning your home into non-tax deductible debt or using it to fund your investments. We tackled some interesting topics here about debt, usage of debt, how to think about that, tax, all kinds of stuff. It's a pretty high level discussion, but I think it's going to open up some doors in people's brains in how to think about this kind
brain
of
doors. Yeah.
brain doors.
Yeah.
What are some of the key points that we covered, Gabby, and who do you think is going to benefit from this episode?
I think people that are going to benefit are like it is a super high level strategic conversation. So it's like if you enjoy the strategic aspects of real estate and this whole game, and you can kind of see real estate as a big like chess game, I think you're going to get a lot of benefit out of it. It is. I really enjoyed this conversation because it's high level, being like, oh, how do we move pieces around? Directly benefit from what we talk about. It's primarily actionable for homeowners. So the concept is that it's a strategy for homeowners and how to convert your debt on your home into a more effective kind of structure. Yeah, what do you think, Goose?
I think you covered it. You nailed it. I think it's fantastic. And so without any further ado, I've got nothing to add to that. I think you've covered it. And it's going to be a great episode if you fit one of those categories. And even if you don't, there is some great gold in there for you to check out as well. So make sure you like, share, rate, review, comment, do all the good stuff. Wherever you're listening to this, there's probably some way to interact. And if you could do that, it'd be great because it's going to help some kind of algorithm to give this to somebody else. And it's going to be wonderful. And we thank you for it. But the other real cool thing you can do is you can actually send this to somebody else. If you get this via email, if you get this on some other place on the internet, you can share it with somebody who's going to like this as well. The more people get listening to the podcast, the better that we get because we'll get more feedback and everything like that. And on that note, if you have any feedback, send it to us, hello@dashdot.com.au. That'd be awesome. We love hearing from people that are listening to the show. And it's really exciting, all the feedback that we have been getting. It lets us know how many people are out there listening to it, which is great. And the more feedback we get, the more enriched we get to bring more valuable content to you. So it's a self-fulfilling prophecy. The more you give us, the more we give you. Now, without any further ado, let's get stuck right into it. I look forward to seeing you on the inside. Hey guys, welcome back to the Investor Lab. You with Goose and Gabby. Gabby, how are you?
I'm good. How are you?
Good. What's going on?
Not a whole lot.
Not a whole lot?
Not a whole lot.
What's going on with me? Lots is going on with me, actually.
Tell us a story.
Well, geez, I'm a little bit. There's a lot going on. The team is growing. We're doing a lot of really amazing investment into technology and research, which is super exciting.
Yep.
That's kind of, I guess, at the forefront of my mind at the moment is the work that we're doing to, to really transform the way Australia invests. You know, we're investing heavily in not only just the research component, but also how do we optimize that whole side of the way people think about investing. And that's a very unique set of problems to solve. You know, like how can you predetermine growth in an area? How do you determine long-term viability? How do you systematically look at that? How can you find correlating trends across 15,000 suburbs? It's really fascinating. It's really interesting.
Yeah. You're absolutely loving it though, because I see you whenever you have chats about it, getting really into the data and figuring out these massive problems, and you're like, oh,
well, it's a huge problem to solve, right?
Yeah.
So it's and I love solving problems. The whole reason we started this business, right, was to solve a problem. You know, like if we go back to the whole premise of why we started this business, it was, we had a problem. We bought the wrong property, wrong place, wrong time, and then went, oh, hang on a second, this kind of sucks. how would we not do that? And so that's obviously been a quest for the last few years, is continuously trying to solve that problem better. Like, how can you increase the probability of success and decrease the probability of failure? And how can you do that on an increasingly larger scale? So yeah, I love solving big problems. So that, I think, is that's at the forefront of things that are going on with me. But yeah, life's good. Last episode, I was like, had insomnia, and I was like, my God, I think my face was hanging off my head, but I feel good. I've been
Are
sleeping.
you sleeping?
I'm sleeping. Yeah.
Wonderful.
Cut down on the caffeine a little bit.
You have. I'm proud of you.
Yeah. Been,
not getting your 4-shot long blacks.
Indeed. But no, life's good. I'm happy.
Cool.
I'm happy. So
I know it's funny. I say not much is happening. There's heaps happening, but I think I feel happy. I feel relaxed.
That's good.
Yeah.
I'm glad. I'm glad. And it's a really interesting time in real estate, right? There's a lot of hubris, there's a lot of excitement, there's a lot of activity, there's a lot of questioning, there's a lot of stuff going on. Like, hey, the property market's booming. Should I have FOMO? Is it going to last? Is it a sugar high? Is it going to, all of that kind of stuff? And so it's just a fascinating world we're living in at the moment, with all the different things that are going on a macro level, on a micro level, on a personal level. But life's good. Life's good. What are we talking about today, Gabby?
Well, this is a topic we've kind of been chewing on for a while, because I think it's a really interesting topic, but it's debt recycling. So it's something that we particularly like. We speak with a lot of clients that kind of this strategy might help. So we thought we'd just kind of talk about it.
Totally.
And what it is, who it's for, what the benefits are, all that kind of stuff.
Yep. A couple of caveats to this episode. 1, we're not experts. 2, this is not financial advice. And 3, go and speak to a professional. But
go get a tax person.
The reason we wanted to talk about it is because it is an interesting strategy to consider in the mix of different things that you can apply in your portfolio. Or maybe it's more of a tactic, I guess, in a sense. But it's probably goes first.
People love these kind of strategies as well. Like it's a cool like high level. It's almost like a game of chess, like this whole real estate thing. It's like a different strategy. Like, oh, okay, how do I move that around to make this thing work and be more efficient and that kind of stuff. So
yeah, exactly. Yeah. So. And again, this isn't going to be for everyone. Like, this is, we often talk about rent vesting and the benefits of rent vesting, and there's a lot of benefits of rent vesting. And in fact, some of the benefits of rent vesting are actually tax benefits and stuff like that, increased profitability and all that kind of stuff. And
not tax advice.
Not tax advice. We are not financial advisors. But we're just people hanging out, talking about ideas.
Yes.
Yeah, if you act on anything in this episode without consulting a licensed financial professional, then well, don't. But what we're talking about today is not relevant for people who are rent vesting. Right? What we're talking about today is debt recycling, and debt recycling is ultimately a strategy that aims to reduce your current non-tax deductible debt, or turn your home from a non-tax deductible debt into a tax deductible debt, right?
Yeah.
And so what that can do is, obviously a lot of people want to, they don't want to have the liability of having to pay for their home loan and all of that kind of stuff. A lot of investors have a home, and a lot of people who don't have a home that are investors, who might be rent vesting now, want to own a home. There's a huge big psychological piece in owning a home. It's not, a lot of people can look at the mechanics of it and go, well, I'd financially be better off if I just never owned a home and I rented forever. But that doesn't necessarily meet the needs of people on an emotional and spiritual level.
Yeah, it doesn't satisfy everyone.
No. And I often say to people, I obviously have the benefit of speaking to a lot of different people from all walks of life that have an interest in investing, and people are like, oh, should we sell the home, or should we buy our principal place of residence and everything like that? And it's like, well, like financially, maybe don't buy a principal place of residence. but it's not all financial. You know, we always talk about investing. We always talk about investing and say, oh, it's not emotional. So it's always emotional. It's 100% emotional. Like
we're human beings.
We're human beings. And the entire reason anyone even wants to invest is an emotional reason. Is I want to live a better life, right?
Totally.
Now, better life is so subjective, right? So for some people, better life includes having a nest that they can call their own. Right. Yep. And there might not be any tangible mechanical reason, but the idea that they can say, this is mine and I live there, that can be enough. You know, it's kind of like, why does anyone want to get fit? Staying healthy is one thing, but why do some people want to go to extremes to become like more fit than you would need to live a healthy life? You know, so there's like all of these kind of like differentiating factors in what motivates us to do anything. So
yeah, and even us, like we're rent investors and we're pure like investment. But even us, you know, as we're developing as humans and our emotions come into play, it's like we're starting to think about like, where do we want to buy our home? Like, you know, you have the dream home kind of vision, and it's like that is innately part of within everyone, I think, is like, where's like my nest going to be eventually?
Totally.
Yeah.
Totally. Yeah. And so, you know, certainly it's not to say like, oh, you know, don't own a home. It's like actually, well, firstly, a lot of people do own homes, and secondly, most people want to own a home, right?
Yep.
So one of the downsides with owning your own principal place of residence, home, we'll just call it from now on, is the cost of debt. So unless you own your home outright or on a very low loan to value ratio, well, even, you know, unless you own your home outright, you're going to have some debt on it, right? And the problem with that debt versus debt on an investment property is that the interest is not tax deductible. Okay, so what that can mean is that you essentially have an inefficient use of capital. Mm-hmm. Does that make sense?
Yeah. So I think like the concept with, you know, a tax deductible cost is when you are using capital for an investment purpose. So this is regardless of real estate. This is just like investment in general. If you're using debt, and that debt has a cost, so like you pay interest on it. If you're using that to fund an investment, then you can claim a portion of that interest, that cost of having that debt, against your personal income. So versus, as we were saying, versus in a home, you're not using that debt to generate income, so that's not tax deductible.
Yeah. So what we're essentially talking about is using the equity in your home to invest in income producing assets, which can then pay down the debt on your home, which then in turn you can use to buy more income producing assets, which can in turn pay down the rest of the debt on your home. And so it's an interesting thing, right? Because on the one hand, you're like, I can use my property to pay itself down and not have any debt. But at the same time, what you're actually saying is, I'm going to have debt, and I'm going to have debt attached to my home.
Yep.
And I'm going to be like that. It's going to be like that for some time, but I'm going to be using that debt to pay for itself so that I don't have to pay for it myself. Yeah. Okay. So, go on.
No, even that's like an interesting psychological thing. If we roll on from what you're saying earlier about like emotional humans and our psychologies, and we're all just big balls of emotion at the core. Some people don't feel comfortable having debt. Some people have this psychology, which I think a lot of Australians, it's built into us as we grow up, is I'm going to buy a home and I'm going to pay it down and I'm going to pay principal and interest and I'm just going to chip away at it and I'm going to pay down my home, and that's kind of like debt is a bad thing. So this kind of strategy is not really for those kind of people. If you're like stuck in, I just want to pay down my home and just pay it off. Yeah. Eventually you will get there kind of at the end of this strategy. But yeah, it's you need a certain level of comfortability with having debt, because you are using excess cash flow to pay down the debt, but then you're re-leveraging it out. So it's kind of like your debt level stays relatively similar.
High.
Yeah.
I'd say your debt level stays relatively high. And it's a really challenging concept for people, because, you know, as you say, a lot of people, they want to own their home debt free. And I totally get that. You know, like I do a lot of, and we should do an episode on this as well, Gabby, but in terms of in like vision, vision, morning, morning rituals and stuff like that. I spend time every single morning writing out what my future life looks like, and it includes owning a home.
It includes Gabby, yeah.
It includes Gabby, and includes a super yacht and stuff. But aside from
those two things.
But aside from that, like when I think about our financial future, I do think about the idea of like, well, I mean, you could have 100 properties, or you could have 15 of them and have them debt free. And there's kind of all these different ways to think about it. And the idea of owning your home completely debt free is a really liberating feeling. So like, well, hey, I would live here and I just don't owe anyone any money. I got to pay council rates and stuff like that. How fantastic! It's mine. Yep. Everyone else can go away. All good. However, there's another way to think about it where you can ostensibly create the same framework, but it just requires a little bit more mental gymnastics. And that is the idea that you would have lots of debt, 100% debt on your property, basically, or maybe 80% or whatever, debt on your property. But the debt would be producing more income than it costs to cover the cost of debt on the property. Okay. So, there's a kind of a simple way of thinking about it. How would you feel about having $10 million in debt? Oh my God, $10 million in debt? That sucks. But what if that $10 million of debt was producing $20 million of income? Okay, well, that'd be fine, right? Because you'd be in profit by $10 million. Sorry. Now it's the same general thinking with debt recycling and the way to approach that. It's kind of like, well, as opposed to saying, I want no debt, therefore my cost will be zero. It's actually about saying, hey, am I okay having debt if that debt produces a greater net return? Obviously, in that net return calculation, you have to factor things like risk, okay? Because any investment is not risk-free. No investment is risk-free. So you have to assess risk, and you have to say, okay, well, what is the probability that this will work out or not work out? And can I, what's the upside? What is the downside? And can I live with the downside? Okay, so it's an interesting proposition, right? So put really simply, the idea is if you have a home and you have some equity in the home, then you can, basically get a split loan or something to that effect. Get a separate loan against the equity in your property. Use that to buy, say, an investment property or any income-producing investment. But for the purposes of this discussion, we'll talk about real estate. So buy an income-producing property, so cash flow positive property that produces enough cash flow to not only cover the cost of its own debt, but also cover the cost of the debt that's been taken out of the home and then some, right? Because just having a net neutral position is fine, because what you would do is diversify your wealth base. And just to kind of talk on that for a second, if you had one home, use the equity to go buy 5 investment properties, and then the total net cash flow position across all of it, once you factored in debt and all the operating expenses, was 0, and you produced no net cash flow. But instead of having one house, you had 5 investments in one home, and they were all growing at a rate of whatever 50,000 a year, then you would end up in a much better position holistically on a wealth perspective. Yep. But that's not going to solve the how do I live a better life and not have to go to work thing, because I won't have any income, right? But so there's 2 views that we need to take on all of this, and one is profit, one is cash flow, and profits don't equal cash, right? So you can have a very profitable proposition where you can diversify your capital as much as possible and just make sure that all of the costs are covered and you're in a net neutral cash position, but you're building a huge amount of wealth. That's great. But really what we want to do is we want to be thinking, particularly in the case of a debt recycling strategy, if the cost of debt is $1,000, how do we actually create $1,500 so we cover the cost of debt, but plus also pay $500 down off the remaining principal component as well?
Cool. So how do we see like real estate being the best vehicle for this? Because we've heard of like debt recycling being used, but primarily with shares, because it's like as in you'd have some equity in your home, your principal place of residence. You'd take a separate loan out to against that home, but that would then fund perhaps a shares portfolio that pays quite good yields, and then that would the excess kind of net cash would go back into your home, and that's kind of that recycling loop. So how do you see that in real estate in particular? Like, why does this work really well in real estate?
Yeah, well, it's kind of the same. It's the same equation, right? You still need to work out your cash on cash return. So in the case of shares, let's just say you took out $100,000 of equity out of the home and you bought shares that had a dividend of 5%, right? So you were getting a 5% cash on cash return on your investment. And then if the cost of debt in your home, so for example, the cost of taking that $100,000 out was, let's just say 5% as well, then the dividends that you would receive on the shares would cover the cost of the loan. Okay, so that's obviously not the optimal scenario. Like that's like a zero position, right? Which is fine, but it's not brilliant.
Yep.
So when you think about real estate, you need to think about what's the cash on cash return, which is something that a lot of people don't talk about anyway. Like what is the actual cash on cash return? So the cash on cash return is how much cash did I put into the deal? So for example, if you buy a $500,000 property with a $100,000 deposit, but for the purpose, I'll say deposit, but what I actually mean is all of the expenses, so stamp duty, everything, like how much cash did you put into the deal versus how much cash does it create? So what is the net cash flow position divided by the total cash contribution to the deal? That's your cash on cash return. Okay, so your cash on cash return needs to be high enough that it can cover the cost of its debt and its expenses and all of that kind of stuff. So it's got to be fully net cash flow positive, right, for a start. But then you actually need to look at what the net cash return is, net cash on cash return is. Now, this is all well and good because I think we're understanding the mechanics of like, okay, so if I take money from one place and I put it into another and it costs me money to take it out of one place, but it also costs me money to have it in another place, it needs to produce enough income to cover all the costs of the first place and also the second place. That makes heaps of sense. But there's the other component of this that we need to factor into the discussion as well, and that's the tax deductibility. Now, just to be clear, I've got no problem paying tax, right? But if you pay tax, you're making money. It's all good, right? So tax minimization shouldn't be the strategy. However, if you have the ability to transform non-tax deductible debt, i.e. in your home, into tax deductible debt, i.e. in an investment, you have the opportunity to actually save, or in other words, make money by being more efficient with the way that you're thinking about the distribution of capital, right? Now, the problem is people think tax deduction means that it's free. They're like, oh my God, the interest on my investment is tax deductible. Therefore, if I pay 3% interest per year, I don't pay any interest.
Pay nothing.
It's free, right?
Yes.
And that's just not true at all, right? So a more accurate way to think about it is it's representative of your marginal tax rate. So for example, if you're paying 40% income tax, then and let me do some quick maths on this. Let's say that your interest rate is 3% and you have a 40% marginal tax rate, then you would potentially be able to claim 40% of the 3%, which means your total interest that you would pay on that loan would in actuality be about 1.8%, right? So and this is a mistake I see a lot of business owners make and stuff when they're like, oh my God, you get the full tax write down this year if you buy assets, right? So they go out and buy a brand new car because they're like, oh my God, it's free, right? They said I can claim 100% of it on tax in the first year. Wow! And then they go and buy a $50,000 car, and then they only claim 30-40% against it, and that still ends up costing them a big chunk of money. Be like, oh, hang on a second, that didn't really work out, did it? So understanding that is a really key component in the whole strategy.
Cool. I was just thinking about as well. So, like one of the huge benefits of real estate in this kind of machine is like the leverage component of it. The fact that you can take $100,000 and reap the benefits of $1 million property, if that's what your situation can produce.
Yeah.
And so that like 90% leverage is rare, and it's one of the beautiful powers of real estate compared to other asset classes.
Definitely, that is like that is like if you compare asset classes, it's very easy to see that shares, broadly speaking, grow by about 6 or 7% a year. If you look at the ASX index, properties on average grow 6 to 7% a year. So Why would you choose one over another? Well, one, it's leverage, right? That's the key component.
Yep.
And then you need to look at your internal rate of return. The downside of leverage is to increase your costs. Okay, so
Yep.
if you have $100,000 and you go and put it in shares and you get a 5% dividend payout, it's very clear you're going to get 5% on your 100 grand. Simple.
Yep.
But with if you use $100,000 and get 10 times leverage on it and get buy $1 million property, so 90% LVR, then your cost of debt is going to be pretty high. So the downside of that is that your gross dividend, or in other words, gross rental return,
Mm-hmm.
needs to be high enough to cover the cost of that debt as well. So you have more moving parts. So
Yep.
Inherently there is slightly higher risk and let me rephrase that. There's slightly higher financial complexity. Okay, but
Yep.
the benefit of real estate and the reason you can get so much leverage on it is because it's low risk, right? Risk gets priced into all of these assets all the time, right? So the reason that you can't get as much debt on shares is because they are more volatile. Like you can't get a 90% loan to value ratio on shares. It just doesn't work.
Yep.
The reason that commercial loans are typically much lower LVR, again, is because the risk is high. The reason gross yields are so much higher in commercial real estate is because the risk is so high. So risk always gets priced into an asset. Okay. So that's something that you need to consider and think about as well. So the idea of debt recycling is brilliant in a sense from a financial instrumentation perspective, because you can actually start to use your place that you live as a financial vehicle, right? To start to create more wealth. But you need to understand the downsides, right? So the idea of it, that you just go, great, I'm just going to take all the money out and I'm going to create more money. I'm going to end up, I'm going to pay down the debt and I'm going to live happily ever after is cool, but you need to understand the mechanics of it. You also need to think then also, what are the loan structures and how do I actually want to finance this? What's the best way of doing it? There is and this is not, again, it's not financial advice. This is just a discussion to kind of push and pull the points around.
Paradigms.
To think about the paradigms in a little different way. One argument could be made that it might make more sense for you to, if you're going to take, let's say $100,000 of capital out of your principal place of residence and then use that for an investment property, that you would get an interest-only loan on the investment property. Why would you do that? Because you want to increase your total net cash flow position and pay down your principal place of residence debt faster. And when you pay that debt down faster, so let's say you've taken out $100,000 and then you're still saving and you've still got to have good financial habits. And then you say pay down another $100,000 of debt, and then you can use another $100,000 for another loan. So you can start to then basically buy back the equity in your property and then convert that into a financial tool, right? So this is the interesting way to think about it. Now, the reason that you might not pay down the principal in your investment property, though, is because paying down the principal is profit. Okay, so when we look at profit versus net cash, it's a really interesting calculation to think about, because profit is the total return above costs, right, on any asset. So a business can produce a lot of profit, but a really low amount of cash, right? And so cash flow can be significantly. Am I making sense? Am I just rambling here a little bit?
No, so you're saying that in terms of like principal and interest versus interest only, you should be considering principal as is similar to profit, like in a business.
Yeah,
it would be profit. So it doesn't make sense to be paying that down voluntarily.
Well, yeah. So profit's not cash. So that's the important thing to think about. So you can be stockpiling profit in an asset which it's a less efficient use of capital. So let's say you buy an investment property. So let's say we'll walk through that scenario again. You take $100,000 out of a home, you go and buy an investment property, and then you get a principal and interest loan because you're like, hey, I want to pay down the debt, right?
Yep.
All of that debt's tax deductible. Well, sorry, the interest on that debt is tax deductible anyway. Now, what you're really doing by paying down the debt in the investment property, what you're really doing is creating book profits, right? So you're creating on-paper profits, otherwise known as equity, and you're creating that in the investment property. Now, why would you do that? That's a good question. Why would you do that? You would do that for a couple of reasons. So you can use the equity later, or so that you can decrease the total cash expenses on that property and therefore increase cash flow. Now, in the same scenario, if you have the opportunity to create $10,000 of equity or profit in an investment property versus $10,000 of equity or profit in your principal place of residence, and if in doing so on your principal place of residence was to reduce your non-tax deductible debt in your principal place of residence, it would be more efficient to take that $10,000 and put that against your non-tax deductible debt than it would be to put it against your tax deductible debt, because reducing the interest payable on your tax deductible asset versus your non-tax deductible asset is a less efficient use of capital. Did that explain it better?
Sweet. Yes, that was good.
Awesome. But it's a really interesting paradigm, because then all of a sudden you're starting to push all this stuff around and go, hang on a second, I've got a home. I'm going to use that to get more debt, and then I'm going to get that debt to not even pay itself down. It's like you're starting to really bend the way we think about this quite a lot. But it's kind of like any of these things. If you can understand the game, then you can play the game better. It doesn't mean you need to go and do this, but it means that if you can think about it better, that you can.
Yep.
So the question then would be, would you get an interest-only loan on your principal place of residence as well? I don't have an answer to that. I'm just positing the question.
If this, then that.
If this, then that. Everything in life is an algorithm.
Yes. I've got two questions, actually.
Go on.
I think about it. So I guess with all of this, like, firstly, when should somebody consider this kind of a strategy? First question.
Cool.
And who do people talk to about this? Like which professional? Because I think with a lot of people, you can hear us rambling about this and be like, oh, it sounds like a good idea, but how do I actually put that into practice? And
I'll answer the
to my
second question first.
Go for it.
You should have a good accountant.
Yep.
That's
Tax
step
accountant.
one.
Yep.
Tax accountant.
Yep.
Right, and you should speak to them about this. And you should also have a good mortgage broker.
Yep.
And they should form your financial team together, right? They should be able to communicate together.
Mm-hmm.
So if they can communicate together, then they would have the ability to help you answer the questions that you need to answer in order to ascertain, is it going to be a good strategy for you? That's the only way you're going to be able to do it, because everyone's personal financial situation is different. You know, it depends on how much you're earning. Is it even worthwhile? You've got to do the maths on it. You know, you may end up creating a net benefit of $1,000 a year, but you might end up creating a whole bunch of stress and headache and anxiety in doing so. And in which case you would say to yourself, is the stress and anxiety worth $1,000, or would I pay $1,000 to just not have that stress and anxiety? And that's an investment too, right?
Yep.
The investments we make are not just purely financial, right? The investments ultimately are always about us having a better standard of living. So you've got to make sure that you're considering the cost of a financial return versus the cost of an emotional return. And that's a real true cost in investing. So there's no point in being stressed out of your brain to make a small amount of money if you would in turn just exchange that money to not have the stress. That's something to consider.
Yeah, I think rolling on for that, like emotional return as well. It's like you actually having that team is actually a really good emotional return to have a team that you can have these conversations with. And I think that's actually, circling back to where you started, is a really interesting point in terms of connecting your mortgage broker with your accountant and making sure that they're in communication either with you or like without you, where they can just converse together about your strategy. Because I think a lot of people, like if you're serious about like buying quite a few investment properties, then that's kind of a crucial thing that's really going to help you if there's communication between them. So it's not just going through you and then you communicate with your broker and your broker needs this thing from the accountant and that kind of thing. If you can connect everyone, I think that's really helpful.
100%. Yeah, 100%. And like just on that, so we've got some clients where we are buying a lot of properties for them, to the degree that I am connected with their mortgage broker and their accountant, and we together, the three of us, form a part of their core team, right? So I speak to the broker and I say, hey, we're looking to buy another property. We're buying roughly a property every sort of month or 2 months for these clients. So I say to the broker, hey, like how are we looking? Are we still all good? He talks with the accountant talks with me and the broker. We all talk together and we say, yes, cool. What moves can we make next? Let's do that. But it's a group effort, right? Yep. If you want to start getting serious about this, you need to start thinking about that team.
Yep. Meanwhile, the client is building their business and they're involved, but you know what I mean. There's this team on the side that are doing this for them. So
yeah,
it's cool. Yeah,
it's pretty sweet. It's pretty sweet. So then that first question was, who is this for? Is that what you asked?
Or like when should people use this? Like I'm sure there's people that own a home and maybe have one investment property. It's like, is now the time? Like how would they know?
I think honestly, I think it goes back to the first part of that. It's like you have to go and talk to your accountant and your broker.
If it's
like
worth it, I guess.
Totally. Yeah. Because it would be impossible for me to sit here and say, if you've got equity in your home, you're an idiot and you should go and put it in an investment property. Like that doesn't make sense. Like you've got to look at the whole financial situation. This isn't a magic bullet either. Like if you don't save, right? If you are not a good saver, if you don't have a good financial IQ, if you don't have good financial hygiene, if you're looking for some kind of magic bullet so that you can just like spend more money on chips and Netflix.
Chips and dip.
Chips and dip.
Classic.
This is not a chips and dip strategy, right? So, at least not in the short term.
Chip-free zone. Get out of here.
Get out of here with that tzatziki. So,
what was that?
I don't know.
Tzatziki.
Nice.
Delicious.
In any case, it's not a magic bullet, right? So it's actually a pretty complex thing, which is why not a lot of people talk about it, right?
Yeah.
However, it is if you have the right financial fortitude, financial IQ, financial habits, it can be a really good tool. Mm-hmm. And that tool can actually help you to expand your wealth and actually increase your cash flow over the long term. But you have to be comfortable with debt. And you have to not just be comfortable with it, but actually be realistically able to tolerate the risk, right? Because some people can be really comfortable with things that they're actually probably shouldn't be that comfortable with. Mm. You know, oh yeah, I'd love to have $1 billion worth of debt. It's like, yeah, but you can't even save for a pair of shoes. So probably not that responsible. So you need to, and sometimes the only way to ascertain that kind of stuff is to get an objective perspective. Like, go speak to your financial team and say, hey, I'm thinking about doing this. Is this going to work out better or worse for me? Can I get some advice on that? Now, and if you're not satisfied with the advice they give you, go and speak to somebody else. Like get second and third opinions. This isn't a one size fits all solution. And this is not just for anyone who owns a home. Go and do this.
Yep.
However, it is something to consider if you're looking to reduce the cost of debt on your home and be able to replace that with another source of revenue, right? And
yep.
Does that kind of answer the question?
Yeah, but I guess like high level, it would be homeowners if you own a home and you either have or are looking to get cash flow positive properties, right? Like
it only works if you're producing cash flow.
Yeah, and it only works for homeowners. So it's kind of like if you're in that situation where you own a home, or like you have a principal place of residence, and you either have or are looking to buy cash flow positive properties, then it would be worth talking with your financial team about debt recycling and whether this is a good decision for you.
Totally.
Yep.
There's a whole nother, I just thought of this, there's a whole nother reverse way to think about this as well, is if you're rent vesting and then you build up an investment property portfolio and then use your portfolio to buy your dream home, but if that dream home is bought and I'm just making this stuff up, guys, just to be clear, right? Just to be clear, I don't know if this works, right? But let's see where
it goes.
Yeah, if you then use your investment property to fund buying your dream home, but if that was bought in a trust and not in your own personal name, but then you rented back off that trust, then you would be a tenant. So that would be an investment property. And therefore, that debt would also be a tax.
Nice.
Boom.
Wow.
What do you think about that?
Just a quiet because they're both like, that sounds like it would work.
Yeah, that sounds like it would work, right? And I think the key with all of this is just to really understand that it's all a game. It's all a game of finance. So it's a game with high stakes, right? Let's not stuff around here. Like it is a game with high stakes, right? It's not a game that you want to stuff up and just take unnecessary risk. But like just that example of going, well, what would it take if I already had a home? How can I convert that home into a tax deductible debt? Right? How do I turn my home currently into a tax deduction? Then if you think about it on an inverse, said, well, what if I wanted to buy a dream home and I just wanted it to be a tax deduction from day one? What would that look like, and how would I need to think about structuring that? And what would be the difference between me being the homeowner and me being, being an investment property, and what type of loans would I need to get on that? So there's very interesting ways to think about that.
Sweet.
Sweet.
Cool. This is fun.
It is fun. Is there anything you think we didn't cover? We kind of talked about what it is. We kind of talked about how it works, super high level. We talked about who it's for. We talked about some of the benefits with it, some of the downsides with it as well. Complexity, stress, when you would use it. Yeah. Oh, a couple of different ways to use it. So there's a few different ways you can think about doing this as well. So and again, talk to a broker about this, but some of the ways that you can get the equity out of your property to use it for this kind of purpose, you could get a line of credit. Typically, line of credits cost a little bit more. You could get a split loan or a refinance or get a cash out. To do it that way, you can get an interest-only loan or principal and interest loan. There's a few different ways that you can take the equity in your property and carve it up to take it back out. That's an interesting thing to think about as well, because a lot of people don't think about line of credits and stuff. Yeah,
from like a portfolio operational perspective, they say it's best as well to not just do an equity redraw from your home and then increase your home loan, like your PBR loan. The advice is to get a separate loan, whether that's a line of credit or a split loan.
Yeah.
Primarily for by the time tax time comes around, you basically just get one statement that says this is how much interest you paid, and that's the tax deductible portion.
Well, it's actually, there's another reason too. If you have your home loan, it's non-tax deductible, right? Yep. And if you just extend your home loan, you're extending your non-tax deductible debt.
Yeah. Yep.
So if you want to take your equity out and turn that portion of the whole equation into a tax deductible component, it by definition must be separate from your home loan.
Yep.
So you have to get a split loan. You have to get a separate facility to take that out. Yep. You have to find some way to separate it from your existing home loan to be able to use that in an effective way.
Yep.
Awesome.
Important.
Important to know. But again, your financial team should be able to support you on this and be able to give you the right advice in order to effectively execute this strategy. And again, make sure that you're buying assets that are going to be able to support this, and make sure you do the maths on it and do the right numbers. But I think we've given this a good run.
Red hot crack.
Red hot crack. Awesome. Yes. Guys, loved your feedback. If you enjoyed this, if you think we got anything wrong that we should have included, if you're out there and you're an expert on this, and you're like, I'd love that. You did not cover this property, then maybe come on the show, maybe be a guest and reach out to us and let us know. Because our goal with this episode was not to try and say, God, we're an expert in this. It's actually to bring another idea to the table to say, hey, have you thought about this? Where does this idea fit in with your portfolio and all of that kind of stuff? And it's a really interesting idea. And if anyone's got better insight on it, we'd love to talk about that as well. If this has helped to open your eyes to a new way of thinking about tax deductible debt and your home and all of that kind of stuff, let us know. We love feedback. And if you think this might benefit somebody else, make sure you share it with them as well.
Awesome.
All right, guys. We look forward to seeing you on the next episode. See ya.
Yeah.